The two big growth levers that everybody was expecting they would pull, one was, of course, the ad business. That doesn't look like it's going to be a huge contributor in 2025. It looks more like a 2026 event. And then, of course, the event that we were all waiting for, which was, a price increase on their standard plan in the US. And they didn't announce that. And so the fact that they're able to guide to solid double-digit revenue growth without pulling any of those growth levers just tells us that there's a lot more juice left in this business, even with, just plain subscriber growth.
All right, lots of good news coming out of this report. Where are some areas that they could have done better? Is there any areas that people are critiquing?
I think the areas that people are critiquing is really just the lack of disclosure around advertising. And one can understand why they are holding their cards close to their chest. So this is still a very small business. They have not disclosed the number of subscribers that they have on the ad tier. And that's color that investors and the whole investment community has kind of been looking for a long time. But they did give us some qualitative kind of guidelines, right? They said that, yes, we are growing pretty fast, but it's off a small base. Don't expect the advertising business to be a huge growth driver in 2025. But I think come 2026, that completely changes.
Where are we on programming budgets, Geetha? Because I think one of the things that you and I worked together, we were just shocked at the early days of Netflix and the types of money they were willing to spend, the billions of dollars they're willing to spend on their programming budget, and that forced everybody else to kind of keep pace. Where are they with their spending strategy? Do they have to keep spending to get subscribers?
I think they do, but they're doing it in a much more intelligent, much more efficient way. And the ROI on the content spend has absolutely, increased so much, Paul. And that's just because, it's been a function of just the operating leverage that they have in the model with the scale and the way that they're able to spread those costs over, a 285 million subscriber base. So, yes, there has been some content cost rationalization across the board, including Netflix. They are still spending about $17 billion this year on content, which makes them one of the biggest spenders in the streaming space. They are planning to increase their budget a little bit going forward. So I think close to about $18 billion in 2025 is what the general estimate is. But then again, remember, they are looking to build out an ad business. And for ads, you do need to invest in different kinds of programming, not really the heavy entertainment programming. It probably has to be more a live sports or a live events type of strategy. And they, I think, are willing to kind of splurge on that to really build up and scale up that ad business.
How's the debt looking on their balance sheet? I know they're big spenders, especially as we think about all the shows and the movies that they're rolling out. Are they staying above water?
Oh, very, very much so. They have about $14 billion in debt, but remember, they have over $7 billion in cash on their balance sheet, and they're going to throw out $6 billion this year. So, absolutely in very, very good shape.
So the $64,000 question, Geetha, which I'm sure you get asked by your institutional investor clients all the time, is how about everybody else? When you see a Netflix quarter like this, you're like, boy, how's everybody else going to compete against these guys in the streaming world? What are you saying to them?
Yeah, so they definitely, Netflix has definitely won the streaming wars. They're going to keep it that way. We know that they have about 10% of all viewing time in the United States. So they obviously see much more upside for themselves to kind of grow. And I think that's exactly what's going to happen, as they have more and more plans, cheaper plans with, of course, the advertising-based tier. And of course, as they have more and more must-have content. So there's definitely the competitive intensity is absolutely easing, which allows them to be a dominant player. But I think also Netflix is really showing the other players how it's done. So one of the big points that came out yesterday from their earnings report was the fact that they've increased margins. Remember, at the start of 2024, they said 22% operating margin. Yesterday, they're saying 27% operating margin for 2024. And remember, Paul, I mean, you know this well, the bogey has always been about 35% margins, and it looks like they're going to be able to get there in the next couple of years. So this is going to be, and probably even more profitable model than the traditional TV model, which is great news.